Studio in New York City. I'm Julie Hyman. That's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. We're an hour away from the close on Wall Street. The Dow and the S&P 500 are firmly in the red, but well off the lows of the day. We've got the Nasdaq hovering unchanged. Concerns over the Fed staying higher for longer also sparking a sell-off in the bond market. We're tracking all the market action and getting insight into the Fed's next move following Chair Jay Powell's interview with 60 Minutes.
Plus, the tech layoffs to start the year piling up. Snap, the latest company to announce a round of job cuts, roughly 500 jobs, and it comes a day ahead of earnings. We're taking a look at the labor market and which sectors could be hardest hit by artificial intelligence.
And in today's edition of Goodbye or Goodbye, we're looking at the retail sector. We've got to look at two names in the home goods area of that industry. Let's get you caught up on the market action here as we are an hour away from the close of trading. We've got, as we looked at the major averages, not much changed at this point with the exception of the Dow, which remains a little more deeply in the red, off by about 187 points. That's off about 0.5%. A real hit today in the materials sector that is dragging down the sort of industrials and that type of stocks today, helped in part by some negative earnings from Air Products, which we're going to get to later on. But real estate and utility stocks are also falling as we have seen yields go up here on that commentary from Jay Powell. Tech, meanwhile, is in the green today.
All right, so the major averages are down today. It's also been a tricky day at Tesla as multiple headlines are weighing on that stock in today's trade. Hyperscalers lowering its price target on that stock. SAP, the German software firm, saying it is ditching all Tesla company cars. And the Wall Street Journal reporting that CEO Elon Musk has created a culture of drug taking with certain members of the board. Praz Sumarain is here with the very latest. That's a lot of headlines, Praz.
Yeah, a lot to go through there, but a lot of people talking about this journal story. Really well-sourced article here alleging more drug use than we originally thought with Elon Musk, a portfolio of different drugs that he's been taking, right? But the big story here is the board sort of knew about more of these things and didn't investigate these matters further. In fact, in some cases, felt pressured to actually take drugs with Musk in order to kind of curry favor with them. So, I looked at this story and I think of it as more of a board sort of not fully competent, not fully out for what shareholders, their best interests. And Josh, I got to ask you, you've been around the Valley. Have you ever heard anything like this before with tech companies?
Well, a common criticism across all kinds of sectors and industries is that CEOs are often too close to the board. That's not, unusual. You'll hear that about a lot of companies. And so I don't know if you would just ding them on that. I guess the question with this story in particular, and to emphasize, these are allegations, right? That's all. That's what we have. Certainly we have seen Elon Musk smoke marijuana with Joe Rogan. He's talked about publicly as a prescription for ketamine. But yeah, to your point, I think the broader story, Praz, is what it means for the board, and are they as responsible as they should be?
Right. When this comes on the heels, of course, as well of a Delaware court slapping down his pay package and implying that the board was not doing its due diligence and its duty. And I think that drugs are salacious, the drug allegations are salacious and all that. But as we're talking about, really it comes to the core of, is this a board that has enabled bad, erratic, whatever you want to call it, behavior on the part of Elon Musk? And is that indeed best for shareholders? And obviously it's a lot easier to ask these questions, Pras, when the stock is down as much as it is down. It's down something like 40% from its highs last year. And I think it's down something like 27% thus far this year.
Yeah, a quarter of the value kind of gone in the last month. And the big thing you mentioned is that case, a Delaware case about how the judge there said that the process to determine Musk's pay was, quote, deeply flawed. The judge said that Chair Robin Denholm was lackadaisical in her approach to oversight with Musk and everything sort of going on with that company. And I think that...
Although isn't it also true, Praz, just a minute, that, and correct me if I'm wrong, Tesla investors saw that plan and voted on it, right? And then Musk hit his targets. We should note that. It's not as though it was under the radar.
Well, the allegation is that they were not transparent enough when they set the targets and that they were sort of low-hanging fruit for him to hit. Isn't that the sort of
But they saw the plan. That's
here?
my point. I just want to make it clear to the audience. It's not as though this is just on the board. Tesla shareholders saw that plan, approved it, and he did hit his targets. Now, some of them are apparently arguing, well, I didn't have all the information I should have 10 years ago. A lot of people, we can also skip ahead and say I didn't have the information I had 10 years when I should have. I just want to make it clear to the audience they did see the plan, correct?
It's interesting because these targets are really audacious, right? And somehow he hit them, and he made a lot of money.
In 2018, people didn't even know if Tesla was going to be around.
Right.
Right.
But it makes you wonder, sort of Musk has been sort of, I don't want to say cagey with the truth, but basically kind of audacious about what the goals can be for the company to hit. FSD is one big sort of factor here. Did he sort of make some promises that weren't necessarily going to be true in order to hit these big audacious goals? I'm just alleging that because he really hit some. If you're a shareholder, you look at these goals, they're pretty very, very, very out there. You wouldn't necessarily think they would hit all of them, but they did from a stock price point of view. And then he got the big award. So what does that make you think about what he says about the company going forward? I'm not sure, but the board should be more on top of these things, I think. And I think you're right, Julie, about that. What are you disclosing about what this package is exactly to the actual shareholders?
Right, and what are the relationships between the board members and Musk himself? It seems like some of them have relationships with his privately held companies as well. Also, as the Journal points out, they are unusually well paid versus board members across corporate America.
Right, exactly.
So that's part of it too.
Massive payments. There's one quick thing I'm kind of curious about this. In the Valley, at least, right, you have a lot of people who are on boards, who are executives, who own bits and pieces of other companies. Was it more so the case with Tesla than other tech companies, for instance, like the PayPal Mafia, people like that? Like, is that sort of the norm out there in the Valley? I'm not sure.
Well, I'm sure any number of directors, probably there is a sense of a kind of live and let live, right? Where you feel like, listen, this guy, when he goes to Burning Man, what he's doing on his own time, as long as it's not affecting the business, maybe the feeling is I'm not going to step in at this point, right? Now, this journal article raises a host of new questions, but I think you kind of nailed it. That's sort of what's really being debated here is that relationship.
Yeah, and then long-term value for stockholders, right?
Yes, most definitely.
Yeah.
All right, thanks, Pras. Appreciate it. Well, members of the Federal Reserve continue to temper the market's expectations around rate cuts. In an interview over the weekend with 60 Minutes, Chair Powell reiterated a March cut is unlikely. And in separate speeches today, Chicago Fed President Austin Goolsbee and Atlanta Fed President Raphael Bostic both declined to comment on timing for future cuts. But Goolsbee emphasized the need for more good data before rates could be brought down. The week ahead is full of scheduled speeches from Fed members as investors eagerly await any further indication of the policy path ahead. With us now is Ryan Deutsche Bank, senior U.S. economist. Hey, Brett, good to see you. So, it feels like at this point there's not really a heck of a lot of suspense around further Fed speak. The message is pretty much loud and clear at this point. It's not going to be March, and we're not really sure when it's going to be.
Yeah, thank you for having me on the program, Julian. And that's a good point. In a data-dependent sort of forward guidance mode, they don't really know exactly what the right time is going to be. And they probably have a few things that they'd like to get out of the way on the agenda beforehand. As Powell talked about at the last meeting and the last press conference, they did intend to discuss balance sheet strategy at the upcoming March meeting. So that's an important one, I think, that they want to get out of the way first. And as you noted, this is a Fed that wants to be absolutely sure that inflation is on the right path for them to begin cutting rates. The most important thing for them is not to get in a situation where they begin to cut rates and then inflation reaccelerates and they have to reverse that process. So they definitely want to see more data to be sure of that timing. And so, for them, they don't want to get stuck into pre-committing to a certain meeting or date with respect to the beginning of rate cuts. And as long as the economy is, performing as well as it has been, that makes a lot of sense in terms of a strategy.
In terms of how the economy is performing, Brett, I want to get your take. Powell on 60 Minutes said, listen, I'm not, when asked whether they have achieved a soft landing, he kind of said, listen, I'm not ready to go there yet. But what do you think, Brett?
Yeah, so far you can't really, ding the Fed too much, really. You've had one of the sharpest rises in interest rates, and yet at the same time, we had 3.1% real GDP growth last year, with core PCE coming down close to target. On a 3 and 6 month annualized basis, you're essentially back at target. So, it's been a great outcome up until to date, really, with respect to the Fed and being able to, not experience any, significant labor market pain, despite a disinflation, campaign that historically, when the Fed has had to, push back against inflation to this degree, it's resulted in recession, and thus far, that's not been the case.
Brett, what do you think the Fed is really waiting for when it says we want more good data? Is it just further confirmation that the robust labor market is not going to cause a resurgence in inflation? I mean, what's really going on here?
Yeah, I think it's going to be the realized inflation data, most importantly. And you've seen that with their forecast at the December meeting, how important that of an input that was into their forward outlook. So it's the next 2 to 3 months of core PCE and core CPI data that the Fed's going to be paying very close attention to. And the short-term trends, the 3-month annualized and 6-month annualized, to see if they're still on the right track in terms of making progress towards their 2% goal. I mean, other factors, obviously the labor market is great. I think that the near term doesn't seem to, to show much slowing, even though, the January jobs number is probably a little large, and there might be some factors that have boosted it. But at this point, I think it's really comes down to the inflation data.
And Brett, switching gears, I want to get your take on the commercial real estate market as well, because it's interesting. Powell on 60 Minutes talking about that issue, saying, listen, he thinks small banks are going to close or merge because of that weakness, but ultimately said, listen, I think it's a manageable issue. How are you thinking about it?
Yeah, it's definitely a risk that's out there to the regional banking sector, but it's also been a well-known risk for a significant, a long period of time. So, I think it's one where the Fed has been watching this sector really since 2016, and the valuations. It has asymmetric information when it comes to, the regulatory side of things, and is probably keeping a close eye on the regional banks with the most exposure. There's likely to be some pain to be felt. Will it be systemic in nature is the key question. And, we would agree at this point with the Fed that it doesn't seem to be a systemic risk to the banking sector as a whole. Think about we removed it in the last meeting statement, they removed the paragraph about the resilience of the banking sector. And that's an important, almost sign of continued health.
By the way, shout out to your team's title on it. So FOMC recap note, March sadness. Yes, we appreciated that with the Fed making it clear that it's not going to be in March, that it is cutting. Okay, so bottom line, putting all of this together, Brett, how many cuts are we going to get, and when are they going to start?
Yeah, so our previous forecast had been for about 175 basis points of cuts. But that forecast also assumes a weakness in the first half of the year. It increasingly looks unlikely that we're going to get as weak of a first half of the year as our forecast. So I would say I think relative to our current published forecast, we're likely to see something on the order of 100 basis points of cuts this year, as opposed to what we've had published previously. So, there's scope for, as we saw recently, for market disappointment, just specifically with March, as you mentioned, March sadness. And I think that the Fed's tried to push back a little bit in terms of, the markets front running, easing, Fed easing, because they're not there in terms of the data they still need to see ahead.
And Brett, I want to get you out of here on this. It seems like, Brett, this is going to be a very politically interesting period for the Fed, because you have Trump out there saying recently, listen, if I'm reelected, I'm not reappointing Powell. And then Senator Elizabeth Warren, she's out there too saying, listen, the Fed should be cutting. She's saying to kind of help out home buyers. Powell at that presser, and then again on 60 Minutes, kind of reiterating, listen, politics is not a factor here. But how do you think Powell and the Fed kind of navigate all this, the politics here?
Well, I think the Fed's going to ignore it. The best way for the Fed to maintain its independence and to do its job is to ignore the politics and stick to the data and what the data imply for the appropriate level of monetary policy. And we think they will do that.
Brett, thanks. Good to see you.
Thank you. Thanks for having me.
We're just getting started here on Yahoo Finance Live. Coming up, Nvidia shares hitting a record high in today's trading as Goldman Sachs raises its price target for the chip maker. And there's a lot of anticipation over earnings. We've got the details on the other side. Plus, speaking of earnings season rolling on this week. After the bell, we'll get you the latest from Palantir and look ahead to what to expect from Disney on Wednesday. Plus, the newest edition of our series Goodbye or Goodbye. We'll get analyst insight to break down 2 home furnishings companies and help you make the best choices for your portfolio. We'll be right back. Nvidia shares hitting a record high again in today's trading, up about 3%. Analysts have been optimistic ahead of the chipmaker's earnings later this month, sending the shares up by almost 40% this year after a nearly 240% surge in 2023. And that sentiment, by the way, optimism broadly over chips being echoed by the Semiconductor Industry Association today. They say the market outlook is extremely strong, citing a big rebound at the end of last year despite a slow start and predicting double-digit growth in 2024. Let's bring in Stacey Raskin, Bernstein's managing director and senior analyst who covers chips. Stacey, always great to get some time with you to dig into the chip industry. And obviously, people are feeling fairly good right here, especially about Nvidia. And I wanted to start there if we could. They're not reporting earnings for a few weeks, but man, there is a lot of optimism already being baked into that report. Do you think they're going to be able to match it?
Look, I think for now numbers go up. That seems clear. You sort of talked about the semiconductor industry as a whole, and I think he gave the SIA's forecast. Semi should grow, I think, this year. Not everything though, like not everything is made equal, but one of the areas I think should be growing a lot is AI. And they are clearly like the most exposed to that space. They're one of the few that are actually making real money in that space. It's one of the few areas where expectation, not just expectation, but actually reality across the players that are there, where those expectations are actually getting upgraded rather than downgraded. I think for now, for Nvidia, numbers likely go up. They're still going to be shipping everything I think that they can make, and so we'll see if it's enough to match the expectations, as you put it. But I would even push back a little bit there. Like if you're looking at valuations, which are like a signal of expectations, Nvidia is actually one of the cheaper AI plays. The stock today is trading something like 32 times forward earnings. Those earnings are likely to go up, I think, in my opinion. It's way cheaper than AMD. It's cheaper than Marvell. It's even cheaper than Intel right now. So I would argue that like expectations, I mean, they're high. Maybe they could stand to even be higher.
And Stacey, I'm interested, we just heard from the hyperscalers, right? Those big cloud giants, Amazon, Microsoft, Alphabet. When you heard their capex plans, Stacey, what were the big takeaways from that for chip investors?
Well, capex is going up,
Yep.
which is good, especially on the AI front. One of the broader questions for AI is there's a lot of investment going on, sure, but you can sort of look at some of the numbers that are there for Nvidia or others, and you say, well, where are those dollars coming from? Like, we want to see capex go up, and we are actually starting to see that now, I think, in a bigger way from a lot of the hyperscalers and some others. Capex spending is going up.
So let's circle back then to the point that you made that this is not a monolithic industry, right? That there are going to be those that are more leveraged to AI and the other stuff that there's demand for. So I guess I'll take the other side of it. Who is not going to be benefiting from that trend that investors maybe should stay away from right now?
Well, let me separate stocks from revenues right now. Let's talk about revenues. And you're right, the SIA, I think, said they put out a forecast for growth. Fine. Semiconductor should grow this year. We were down about 8% last year, and memory was down a lot, and non-memory was down a little. This is an asynchronous cycle. Certain end markets are sort of through their cycles and returning to growth. Other end markets are kind of in the meat of it, and others are just starting to roll. So AI is clearly off the charts, like that's growing. Things like PCs and smartphones, which actually went through their bathtubs, they were very weak last year. They're coming out the other side of it. Those should probably grow this year some. I'd say things that are sort of like more in the meat of the downturn now, traditional data center server CPUs, networking, that sort of thing are pretty weak. And then I would say the industrial and auto spaces that affect a lot of the analog names, those are just starting to roll. And in some cases like industrial, they're rolling over hard, and auto's starting to show some cracks. I would hazard a guess that industrial and auto end markets probably do not grow revenues. They're probably down this year.
And Stacey, while I have you, I want to get your thoughts on another name that made some headlines. Intel making these news, kind of delaying the timeline for the company's Ohio plant. I'm just curious, Stacey, what you made of that headline, and what do you think it means for Intel?
Yeah, so I don't, there was people wondering if it meant anything with their process roadmap. And look, I'm not an Intel, I'm not a huge Intel fan, as many know. However, I don't think that those delay announcements, such as they were, had anything to do with their process roadmap. I think it has to do with the fact that they don't need the capacity, right? This is a dynamic sort of thing. Like they are doing construction, they're building the building, but at the same time, these factories it's going to be $20 billion. Like, you don't dig a hole and throw $20 billion into it and then sit around the edge and wait for customers to show up, right? I mean, you build capacity as you need it, and you can look at where their revenues have gone in the year or two since they put out the original timelines for those factories, and the revenue trajectory has clearly changed, right? It's a lot lower today than it was. They're adding capacity in a lot of other places. They probably don't need them on the time frame that they had them on, or on the original schedule, and so it's kind of a dynamic thing. And they'll bring it up and running when they need to bring it up and running. They don't need it right now.
And Stacey, though, for these plants, as you're building them out, these advanced chip making plants, do these companies have the staff for these plants? I mean, it's one thing to build and fill an advanced chip-making plant, but then you actually need people to lead it and staff it. Do they have that labor force?
Yeah, so in fact, it's even difficult right now getting the construction labor force to build them, right? That's not an easy thing. And no, I think this is a broader, let me put Intel aside, this is a broader issue for the semiconductor industry, if you can look like globally at the number of fab projects that have been announced here in the US and in Europe and in Japan and in Taiwan and in China and even in places like India maybe, you need a lot of like highly skilled workers. I can't remember, I think I can't remember if it was SEMI or the SIA, but they put out some number that it was like something by 2030, like the semiconductor industry would need like 1 million skilled workers or something globally to support the infrastructure. So no, I think labor and talent management is an enormous issue as we are bringing these things up and running. Intel, for example, is actually working in Ohio with education. There's some things around the CHIPS Act for labor and talent and workforce. But these are enormous issues if we're going to bring the kind of capacity online that I think is being talked about over the next, like call it like decades. Like you're going to need people here.
Yeah, and I guess a lot of those jobs are not ones that AI can replace, especially when you're talking about actually physically building a thing. But I want to turn to China for just a second, because you and your team were out with a note looking at some predictions for China AI. And they're sort of specific, so I want to zoom out a little bit and just talk about China versus the US and sort of where we are in that development. Can you talk to us about that and sort of where we are and who stands to win, or is it not sort of zero sum here?
Well, so there are export controls now that were put on US companies selling AI parts into China. Mostly they affect Nvidia. They don't really affect others because most of the others, the revenues were very, very small. Nvidia had a sizable business in China. And under the export controls as they currently stand, Nvidia basically can't sell any of these AI parts in China at all. They are working on new parts that will be legal to sell. However, given the performance thresholds that are around these sanctions, they have to drop the performance very considerably. And in fact, there are local Chinese alternatives from companies like Huawei that at least on paper will have better performance than what Nvidia is allowed to sell into China. What Nvidia will have is software compatibility. And like a lot of the existing AI infrastructure and models that have been built in China were already built on Nvidia hardware. And so they're leveraging Nvidia, the Nvidia software ecosystem. And so the Nvidia parts will allow seamless integration with that. And so they're probably more suitable, I would think, for more of the tier 2 developers. The larger ones, in China may go with other alternatives if they've got the resources available to port everything over. I would say long term, though, I kind of view this, my view is once they put sanctions on a year ago, I think long term the China TAM for the US guys is going to be impaired because they've lowered these thresholds, but even if they never did, they were never going to be raised. And so the gap between what is legal for US companies to sell into China in terms of performance and the rest of the world is going to get bigger and bigger and bigger over time anyways. And so I think you do need to think about that TAM ideally as potentially as impaired. Now, I think the overall TAM long-term is enormous. I think it's big with or without China. So I think it's manageable, but you need to do that. I will put aside, by the way, the whole question of was this whole thing the right thing to do? I mean, I can understand the national security implications of wanting to constrain China's ability to build this up. But at the same time, and it's not just AI, it's AI and it's equipment and all kinds of other things. We are forcing China to become creative, right? In all senses of that word.
Well, that's what I was going to ask you, Stacey. I mean, how far are Chinese chip developers from matching Nvidia? You said the Huawei chips allegedly can do what the lower, what the lower performance ones can do. But I mean, it still seems like there's still a pretty big gap between homegrown chips and what Nvidia is producing elsewhere.
It is. And so what does that mean? That means that you'll have to shovel a lot more chips at the problem. So for example, the Huawei Ascend supposedly is roughly equivalent to an Nvidia A100. That part for Nvidia is 2 or 3 years old. On a performance basis, it's roughly equivalent. Again, it doesn't have the software ecosystem and everything, but if you just want to take that, I mean, fine. So that if they want to get the same amount of performance that Nvidia's or others are delivering with their current parts, they'll have to put a lot more silicon in place in order to do that. So that costs money in terms of chip cost. It costs a lot of money in terms of power and infrastructure and everything else. And so is it going to be cost competitive? Like if they had to sell that stuff elsewhere in the world? Absolutely not. It's not competitive. But they have no choice. So they'll do it. We saw the same thing like on smartphones. Huawei is making smartphone chips again, using supposedly SMIC 7-nanometer processes, which are not going to be competitive with what, say, Qualcomm or other main suppliers can provide. And they're going to burn more power. They're going to cost a lot more. But if you have no choice, you will do it. And then over time, you will try to figure out ways to optimize within the constraints that you have. Again, they are going to have to be creative. I don't know what this means, 10 years from now, 15 years from now. but it will be more challenging. And China in general is a big market for U.S. and other suppliers. It's going to be tougher. It's going to be tougher. I don't know what it looks like though as we kind of roll this out.
All right, we'll keep watching. Dr. Stacy Razgon, thanks for joining the show, my friend. Always love having you.
My pleasure.
Markets off the lows of the day, but some of the biggest moves of the day are coming in the bond market. Let's kick it over to Yahoo Finance's Jared Blickery at the Interactive for a deeper dive. Jared.
Josh, the bond market is on fire. In fact, this is the second day here. 10-year T-note yield up 13 basis points. It was only Friday that it was up another 15 or so. We're closing in on 30 basis points for 2 days of price action. This is only a 1-month chart. And let me show you a 5-year chart. First of all, the current market action in context is only right here. So that's very small. Let me put a line chart on so you can see. The last time we saw a move this size in 2 days, that was actually a peak in yields, and that was in the middle of 2022. This was a decade plus high, so it was more significant that we got to that level than right now as quickly as we did, but you have to wonder, I'm going to put a 3-month chart on here. If we are to accelerate along here, beyond here, what does that mean for risk markets? Let me show you the US dollar because that has been accelerating as well. Here's the last 2 days, big move there. Why does the dollar move along with rates, longer term rates? That's because as rates go up, that attracts US dollars. A very imprecise relationship there, but arguably we are seeing an inverse head and shoulders in the US dollar index, and this points to higher highs ahead. And so all of this potentially weighs on risk markets. And I want to show you an interesting correlation. I found this chart. This is put out by Refinitiv. This is the US dollar index going back to the very end of last year in purple versus the number of rate cuts. And this is fewer cuts as you go up. So as the dollar has been increasing ever so slightly, we have been pointing to fewer rate cuts. All of this has important implications because global currencies, global central banks, they compete just the same as everyone else. Here's the US federal fund rate going back over 15 years versus the ECB. Here's the ECB, here's the Fed, here's Japan, all the way down here. There's a very wide disparity here between these interest rates, and there was an equilibrium reached late last year based on the premise that the U.S. is going to be cutting rates. If the U.S. is not going to be cutting rates, that has huge implications for upsetting the global equilibrium. And I'm going to close with a heat map of the U.S. dollar index here, where you can really see how far and how much the U.S. dollar has been advancing. This is year to date, and this is versus all the global currencies. U.S. dollar has appreciated 5.5% versus the Japanese yen. I'm going to show you a 3-year chart. Here's another potential cup and handle here, very loose, but if we were to complete this, this points to a materially weaker yen, and all these things can happen very quickly and come unraveling all at once. Not to be a gloom and doom here, but higher rates have higher consequences.
Jared, thank you, appreciate it. Now checking in on some of today's top trending tickers. Let's get to shares of Snap. They are lower in today's trade. That's after the social media company became the latest tech giant to announce job cuts. It will cut 10% of its global headcount to free up capital to invest in its long-term growth plans. This coming just ahead of the company's fourth quarter results on Tuesday. So it's down about 2% here, Julie, in today's trade. So cutting 10%, that's about 500 jobs. Company saying this is to best position our business to execute on our highest priorities. I did see commentary from some analysts saying, in their opinion, this doesn't maybe bode well for Snap's business, how it's performing, but of course they will report tomorrow, so we'll get a fresh look.
Yeah, it's interesting that they came out with this announcement before the earnings, not accompanied by them, because what's different about this is that the stock is down. Many of the times when we've had these companies come out and say they're doing cost-cutting measures, including, unfortunately, layoffs, exactly. That's what happened. I was just looking at some of the estimates for how Snap is expected to do by analysts. Expected to say sales rose by 6% to about $1.38 billion. Earnings per share, though, are expected to have fallen to 6 cents a share, with daily active users at about 411 million. So those are the numbers we'll be looking for. The stock, by the way, is down about 2.5% or so this year, but it did climb 37% over the past year. And I was also looking at the overall layoff numbers that we've gotten thus far. About 32,000 in tech specifically, according to layoffs.fyi, but it compares to 89,000 for last January alone. So it feels like there are a lot of announcements, but it's still lower than it was last year.
And we should note, not all bad news for Snap. Just want to mention today, Rich Greenfield over at Lightshed, well-known, well-respected analyst, just today took his one-year target to 24, up from 19, says healthy global macro, improvements in ad measurement and targeting, strong growth in subscriptions. So we'll find out tomorrow when they report.
We will. And now we have an example of a company that cut jobs and the shares are higher. Not in tech, though. Estee Lauder is what we're talking about. It also topped earnings estimates and announced that restructuring plan. It includes reducing the company's workforce by 3 to 5%, but the shares are surging by 13%. It's as many as 3,000 people that are going to be affected by these cuts out of a workforce of about 62,000. Estee Lauder is known not just for its namesake brand, but it owns a lot of other brands. The Ordinary, Clinique, MAC, Le Labo, Jo Malone, Tom Ford. It's just a behemoth in this industry here. But it's been suffering from Chinese travel in particular, that basically, because of what's going on with the Chinese economy, Chinese shoppers are not traveling as much. They're not shopping at duty-free as much, and that's something that has hurt Estee Lauder. And
we should note, even with today's big jump there, this stock is still down about 40% in the past 12 months. And the street still is not convinced yet, even with that drop, that you're smart to step in here. Most still on the sidelines.
Yeah, and I should mention they were surprised, it seems to be, by this restructuring plan announced today. So that's part of the share pop as well, is that it feels like that the perception seems to be that the company is taking some necessary steps to deal with the slowing growth.
All right, we'll keep watching. Meanwhile, finally here, take out shares of Air Products and Chemicals in the red today following an earnings miss, a sales slump. Company also cut its forecast for 2024, now expecting earnings between $12.20 a share and $12.50 a share. So that stock's in the red today, Julie. Q1, they missed on the bottom and the top relative to consensus. They cut their outlook for the year's adjusted earnings per share. So what they're seeing, $12.20 to $12.50. Street was closer to $12.98. Company saying results were lower than expectations, mostly due, they are calling out a slowdown in manufacturing in Asia, particularly in China. We know the economy over there has been weak. That is a theme we've heard, of course, from a lot of different companies this earnings season.
Yeah, most definitely. The stock, by the way, that drop is the biggest we've seen intraday since March of 2020. And as you say, it comes back to these concerns over growth in Asia, in China specifically. As I mentioned earlier, we're seeing materials as the worst performing group in the S&P 500 today. That's due in part to Air Products, which is used in a lot of industrial and manufacturing processes. And so you've got that read through for Asia and kind of the little bit of a pressure because of that.
Stocks down today, down about 20% over the past 12 months here. Coming up, newest edition of our series, Goodbye or Goodbye. We'll get analyst insight to help you make the best choices for your portfolio.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Well, several retail names potentially facing material pressure stemming from the Red Sea crisis and Panama Canal drought restrictions. Among that list, we're placing two companies on investors' radar when looking at investing plays in retail and home furnishings retail in particular. Joining me now, Seth Basham, Wedbush Securities Managing Director of Equity Research. Thanks so much for being here, Seth.
Thanks for having me.
So let's get to your goodbye, the one you like first of all, and that is Williams Sonoma. And Williams Sonoma, interesting case here because, first of all, the stock has already done quite well over the last year. But let's get right to your investing case here. And first of all, it is that you think margins are going to do better even than the street is estimating. What's going to drive that?
That's right. Margins are at peak level, and that's driven the stock to new highs. But we think margins are going to continue to go higher, at least 70 to 90 basis points higher than the street in 2024. And the primary driver of outperformance relative to street expectations is supply chain costs. We actually have lower supply chain costs embedded in our inventory in the balance sheet. As they sell that inventory, it's going to increase gross margins and operating margins. So we see a nice upside there in 2024.
Interesting. Okay. And then also, you think generally there's going to be growth in the home furnishing sector, and I suppose specifically also for Williams Sonoma.
Yes, certainly. So the sector itself was very strong during the pandemic. We had people staying at home, redoing their homes, housing took off. And of course, over the last 18 months or so, it's been the quite opposite picture. As we move through 2024, we expect housing to start to grow again, interest rates to come down to help fuel that, and home furnishings to start to increase in sales. So that could be a nice plus for the stock too as we move through 2024.
And then also, there's the idea that Williams Sonoma has kind of changed how it's done business. It is not discounting as much as it once was. It's kind of holding the line on price. And a lot of people are shopping online for their stuff, right?
Yeah, that's right. There are changes that took place in this company that began before the pandemic. They stopped doing site-wide promotions. And they also started pushing their e-commerce business more, which is now 2/3 of their sales. And the margins in the e-commerce business are much higher than the stores business. So their operating margins are now higher structurally and should stay higher.
My understanding also is that they've also sort of expanded, when you talk about home furnishings, decor is also something they've leaned into a little bit. Furniture, yes, but also selling lots of other stuff.
Yeah, that's
that goes
right.
In your house.
Yeah, certainly. About half their business is furniture, half is decor. It varies by brand, but for one of the furniture-heavy brands like West Elm, they're starting to move more into decor, and that should help re-accelerate growth in that brand.
Let's talk about what could go wrong, as we like to do here. And there is the risk of higher supply chain costs because of what's going on sort of globally, right?
Yeah, that's right. Certainly the Red Sea crisis is sending ocean freight rates up materially right now. There are surcharges on current rates. However, as we get into the contract renegotiation this spring, our experts, including the supply chain head at IKEA, thinks they'll only see a 10 to 20% increase in freight rates for 2024. And that's not enough to really dial back all that margin improvement that we forecast.
Gotcha. Okay. And then let's get to your stock that you don't like as much in this space, and that is RH. And this stock has already had quite a roller coaster over the past year or so, is down significantly from its highs, as we can see. Here, the company raised prices pretty aggressively. And what happened as a result of that? Very aggressively.
They fired a lot of their core customers. What we call aspirational luxury customers were priced out of RH. They increased their prices by 50% in our sample of goods from 2018 to 2022. And last year, the company's CEO admitted they probably went too far with price increases. So they're on to the next phase.
So the next phase, though, where they are now, did it happen too late? I mean, can you bring those people back, or can you attract new people who can afford to pay those prices?
Yeah, it's not going to be easy. So they are introducing more value-oriented merchandise, so lower price, a little bit lower quality in some cases, and trying to bring that customer back. It remains to be seen whether or not they'll be successful. It's early stages. They plan on reinventing pretty much all of their merchandise, touching every single collection in 2024. So it's a mammoth feat.
And everything has to go right, I guess, when you're talking about that. They're also expanding geographically in Western Europe. So what are you watching to see maybe if they're going to execute well on all of this?
Yeah, so we're watching how the product resonates in the stores. First, if it gets in the stores on time. Peak inflection is expected in the second quarter, but with the shipping delays, that could be delayed. And with execution risk, that could be delayed. As it relates to the expansion in Europe, they have stores so far in a couple countries. The first country they entered, United Kingdom, their store has been a bust. So far off from meeting their sales expectations. And right now, we don't have a huge degree of confidence that the other stores will be super successful.
Interesting. Okay. Then there's another point that you made, which is how this stock is valued, and especially valued versus Williams-Sonoma. So RH is up here, and then you have Williams-Sonoma that is at a much lower valuation here. And that's been pretty, I mean, they were closer, but RH with its earnings troubles has gotten is a lot more expensive now than it was.
Yeah, that's right. We're talking about forward PEs on our numbers about 22 times for RH, 13 times for Williams-Sonoma. That makes Williams-Sonoma much more attractive in our view. We don't expect a V-shaped recovery in RH's earnings. So with that in mind, Williams-Sonoma is a better buy.
Well, with all of that said, we also like to point out, just like we pointed out, the risks for Williams-Sonoma, the risks to the downside, your downside case for RH, and that's things could go right in theory. What would need to go right though for RH?
Yeah, so execution for one. So if they execute on the product revamp, if they execute on the store expansion, those would be two good things. And the second thing is just the luxury housing market, which they play into. So if luxury housing comes back faster than we forecast, faster than existing home sales overall, that could be a plus for them.
All right, but obviously you don't think that's the case at this point. So let's just summarize what you're telling investors here. Buy Williams-Sonoma, you say operating margins expected to come in above consensus. The home furnishings retail sector expected to grow this year. On the other side, you say avoid RH. It remains to be seen if the company can win back its core customers or even expand its customer base for that matter. Seth, thanks so much for coming in. Really appreciate it.
You got it. Thanks for having me.
All right, that'll do it for the latest installment of Goodbye or Goodbye. Look out for new episodes 3 times a week at 3:30 p.m. Eastern. We'll be right back.
U.S. stocks slipping today after Fed Chair Jerome Powell put a chill on prospects for an early interest rate cut. But as econ data continues to strengthen, have investors eased their concerns of inflation and higher for longer rates? Randy Frederick, veteran market strategist and Randy Frederick Media.com founder, joins us now for more. Randy, it is good to have you on the show. I actually want to start, Randy, with just your take on this earnings season, Randy. Listen, we've heard from the big banks and big tech. What are your big takeaways so far, Randy?
Well, I mean, we're about 50% of the way through, and that's usually long enough to sort of give you an idea how things are going to shake out. And the truth is, it's been pretty much about an average earnings season. We got about 75% of the companies exceeding the earnings expectations, about 65% or so exceeding the revenue expectations. That's about a typical quarter. It might seem kind of high, but if you look at the historical trends, that's about right. You're right. Jay Powell, I think, scared everyone just a little bit, but I don't think he really said anything that surprised anyone so much as confirmed what the Labor Department report last week, Friday, told us, which is that the economy is doing really well. Inflation should be watched, but it's not a major, major concern. But that's not an environment where you cut rates.
And so what are the implications then for stocks? Is that a good setup if they're not, even if they're not cutting right away, if the economy's strong, if earnings are doing all right, then does that imply stocks keep going up?
Yeah, probably, but not at an astronomical rate like we've seen. I mean, for the longest time, in fact, throughout most of last year, we kept hearing from people saying, oh, the market can't go up unless they cut rates. Well, that's not really true at all. There's no reason to cut rates if we don't see falling inflation and falling economic data and things like that. We just don't really have that. What we probably are going to see is the market continue to do what it's been doing here for the past couple of months, which is slow trending upward. But it gets kind of dangerous if it gets a little bit ahead of itself. And I think it may be just about at that point now. Obviously, the S&P 500 is at an all-time high. Nasdaq, I think, is around 3% below an all-time high. Markets tend to move 6 to sometimes even as much as 18 months, although I'd say most recently about 6 to 12 months ahead of the economy. So if the market gets too far ahead, sometimes the economic data will cause a little bit of profit taking, which I think is probably what we've seen today. But if you look across the whole spectrum of economic data, what we're seeing right now tells me we're probably not looking for anything more than maybe a 3, 4, possibly 5% pullback. Nothing even close to an actual 10% correction right now. But the longer term outlook is still quite positive.
And long-term, Randy, also, I want to get your thoughts on big tech, the Magnificent Seven. We talk about these names, Randy, a lot because, listen, a lot of our viewers are in these names. What's interesting is you see investors maybe starting to get a little bit more selective about where they want to pick their spots. How do you think about those names?
Well, I mean, those names, obviously, they're the market leaders. Technology in an up market, in a bullish market, in a decent economy tends to be one of the leading sectors. We've also seen communication services do pretty well. We've seen a little bit of softness in some of the consumer discretionary and a couple of other areas, but you have to always look at these individual companies. Most of them have giant balance sheets. There's no risk that they're not going to be around 5, 10, 15 years from now, but that doesn't mean they're going to do spectacular in every single quarter. Sometimes even a well-established name has been in a little bit of a dry spot from this perspective of innovation, introduction of new products and services. They don't always all perform directly together. As a sector, that mega cap group tends to move pretty much in tandem, but you will see variances between them. So you should be always selective. You should never be completely out of many of these names. What you should do is trim some of your holdings just a little bit, take a few profits off the table as they start getting to multi-month highs or all-time highs, but don't get completely out of them. If you still think they've got potential in the long run, and many of them do, you should never get completely out of them. So, as I said, either trim some of your profits, or what I often recommend people do is put on things like some protected puts to protect the downside, or maybe just sell some covered calls against a portion of your position. That'll generate a little income. It'll give you a little bit of downside protection, which helps smooth out some of these bumps that we see occasionally.
And Randy, finally, you talked about the potential for a little bit of a pullback here. I'm curious what you think the biggest risk is in the market this year, sort of in a bigger way, a more fundamental way.
Well, obviously we do have some risk, but it's much, much later in the year. It comes around the election time, as you know. It's a pretty important election. We could see the economy and just the general political environment continue as it is potentially, or we could see a major shift back to where we were a few years back. It depends on which side of the aisle you're on, whether that's good or bad. but it's going to be a substantial shift and it will change things. But that's way down the road. The market probably won't get real worried about that until maybe the late September, early October timeframe before the election comes along. A lot of these things have sort of already been determined in terms of who's running, those sorts of issues. The other risk, of course, is what we've been seeing for several months, especially since things sort of escalated in Israel back last year, which is the continued escalation of geopolitical tensions in many, many places, mostly obviously around the Middle East. Those issues, as they flare up, they do have a tendency to cause the market to have short-term pullbacks. They generally are not long-term in impact unless the U.S. gets involved in a big way in a full-scale ground assault or defense. We haven't really seen that just yet, but we often feel like we're teetering on the brink of just about getting to that point. Those kinds of things will have a tendency to sort of put a ceiling on upside potential in equities. But so far, so good. So keep an eye on those issues. Like I said, they'll cause short-term bumps, and in the long term, generally not bad unless they really escalate further.
Randy, it was so good having you on the show today. Thanks so much for your time and insight. Appreciate it.
Thanks, Josh. Great being back with you.
And coming up, closing bell on Wall Street, we're checking in on the latest market moves and the top trending tickers. Stay tuned.
There's the closing bell on Wall Street. So let's check the markets when everything was said and done. The last time we checked in, stocks were a little changed, particularly the S&P and the Nasdaq, but we've seen a little bit of a leg lower in the last hour of trading. The Dow finishing down by 0.7%, about 276 points there. The S&P off about a third. The Nasdaq off by about 0.5% by the end of the day here. We earlier talked about air products and chemicals. That was the worst performer in the S&P 500 today with a 15% drop. On the flip side of that, Estee Lauder, which we also spoke about after announcing restructuring, those shares finishing the day up by about 13%. So that was sort of the push and pull here today as investors also debate when that first rate cut is going to come. So that also feeding in, of course, to what was going on in today's session.
Yeah, you look at the bond market, as Jared Blicker was pointing out, there's the action. Look at these moves. The yield on the benchmark 10-year, Julie, up about 14 basis points. So that's the Fed. That's stronger than expected economic data. So big moves there.
Yeah, definitely.
Yep. All right, let's get to some tickers as well here. Start with McDonald's. Those shares are sliding in today's trade. That's after same-store sales missed the street's expectations for Q4. So Q4 sales missed, Julie. If you look at comparable sales, they rise 3.4%. That undershot consensus. Revenue also missed. Some of this, it looks like, is being pinned on geopolitical conflict, the segment that includes the Middle East, which accounts for about 10% of total company revenue. That did miss estimates.
Yeah, that was up only a 0.7%, which was well short of estimates. And Chris Kempczinski, the CEO, has spoken in the past about misinformation, or at least sort of polarization affecting the restaurants there. Yep. Different restaurants they're not company owned, they're licensed and owned by individuals, and they offer different promotions. For example, either free meals to Israeli soldiers or raising money for Gaza. So that then caused, I guess, a hit to sales as well, because people then didn't go to some of those restaurants.
Yeah, they've been the target of these boycotts in some places, and even though the companies you said, it said, listen, these are run by these local operators. In the U.S. though, too, we should point out comparable sales growth 4.3%, and that just missed estimates as well.
Right, and Kempczinski saying that there was a slow start to the year because lower income U.S. consumers are ordering fewer items. In some cases, they're ordering lower cost items as well. So that's a trend that bears watching.
Yeah, not in the Lipton household. Yeah, the Oreo McFlurry, strong.
Yeah,
strong.
Big fan.
Oh yeah, strong.
As people who have watched Yahoo Finance know for a long time, I can't recall the last time that I was in a McDonald's. But that's another tale for another day. Let's talk about Coinbase. Mizuho Securities' Dan Dolev pointing to Bitcoin ETF assets under management at Coinbase likely below levels prior to the mid-January launch. Those shares down by 9%. Now, Dolev, in a note here, talked about the Bitcoin ETF as a double whammy for the company. So outflows from ETFs where Coinbase is the custodian, he wrote, exceed inflows here. And that's mostly because of the outflows from GBTC, the grayscale Bitcoin ETF, and that the inflows have not more than made up for that.
Yeah, this is a rough start to the year now for Coinbase. The stock's down about 30% so far this year. Of course, listen, that's after a monster 2023, so just giving that good context. Also, good piece in Bloomberg today. Did you see how the company and CEO Brian Armstrong are kind of preparing, in their words, a war chest to back crypto-friendly politicians? That Armstrong and Coinbase account for about a third of the $85 million now raised by the Fair Shake Super PAC, which has supported folks like Republicans like Tom Emmer, Democrats like Josh Gottheimer. So Coinbase kind of pulling out the checks and working the halls of power.
Interesting. I had not seen that, but I mean, what's interesting about that is Coinbase for a long time has been quite politically active, but that's not going to help it with this core issue, right? The Bitcoin ETF assets, that's sort of separate from what's been going on in politics. I guess unless you start and get in Ether ETF or whatever else, but nonetheless, their ETF AUM, assets under management, according to Dolev, has fallen to about $25.9 billion. It's
Never
fallen
hurts
by
to
about
have
4%.
friends in high places, though. Does it?
I just don't know how much it'll help, but we'll see.
Fair
Maybe
question.
it will. Maybe it
Fair
will.
question.
Yeah.
Finally, Zscaler shares sliding after its chief operating officer suddenly resigned and now joining startup Wiz as its new president and COO. This was interesting. I mean, you could see the reaction in the stock. Julie was down about 5% in today's trade. I did hear some analysts on the street. The reaction was kind of mixed. I heard some analysts saying, this is no good. This is a guy we trusted, kind of built up the sales org.
Right.
Others were kind of countering, not so much, at least, especially from those who I saw buy rings, were saying, listen, yes, it's sudden, took us by surprise, but we don't see risk to near-term financials.
Yeah, I saw the same stuff that you did, and I also saw the stock performance over the past year. It's up more than 70%.
Yeah, it's huge.
And so when you look at a pullback like this, it just looks like a pretty small blip here on the right side of the chart from this management change. I think we'll have to see who is the COO who replaces him, and whether people are, welcoming to that change and encouraged by it. So I guess watch this space.
For sure.
Speaking of watch list space, let's talk about Tesla once again. Those shares sliding today, and top trending ticker on Yahoo Finance. German software firm SAP reportedly will no longer get electric cars from the automaker. Piper Sandler cutting its stock price target on lower delivery expectations this year. And really, there is the backdrop here and sort of the changing sentiment around Tesla. The stock is down more than 20%, really more than 25% to start the year, with issues and questions around Elon Musk's leadership. For more on the future of Tesla and its CEO, we're bringing in Colin Rush, Oppenheimer Managing Director and Senior Research Analyst. Colin, We've had this discussion before, and here we are again as we get more press. Last week, of course, a Delaware court throwing out Musk's pay package. Stories in the Wall Street Journal over the weekend questioning the independence of the board and the pressure that they reportedly feel to do drugs with Elon Musk. I mean, as somebody who follows this stock, what do you even make of all of that?
We try not to make too much of it. There's been a lot of noise about Elon's personal life, and we really try to focus on what's happening with the company from a technology perspective, a product perspective, and the broader market. And the backdrop that you referred to, I think, is challenging. We have higher rates, persisting here, and we saw that sentiment today, coupled with some noise around some of the fundamentals on EVs. And I think the disruption of the auto market is going through the difficult phase. It's easy to get through some early adopters and get some real momentum, but now we're fundamentally changing from internal combustion engines into electrified powertrains, and that's a much harder process to go through. And we think this is just natural growing pains of a end market that's very much in transition.
And let me get your take, Colin. Listen, I get it. As a financial analyst, you're focused on the business, and you know this business, and you know the C-suite as well as anybody. One question I did have, though, regarding these headlines that drop on Elon Musk, and I think it's a question investors have, is there is this view out there, Colin, that Tesla is Musk and Musk is Tesla, that he is simply just, unlike a lot of CEOs, that he is just foundational to where this company is and where it is headed. What's your take on that?
Yeah, I think there's a lot of truth to that. I mean, one of the things that he's brought to the table for this organization is just ambition and vision, and that still, I think, remains the case. But the bench strength for the organization is exceptional. We continue to see this as an organization that's attracting the top talent from a technology perspective, and really working on some of the most challenging and interesting problems in the world for engineers. And I think that's a compelling value proposition for a lot of executives and a lot of engineers that are coming out of school or want a new challenge in their careers. And so that I think is an important piece of this, is that this is not a single person driving this organization, but he does set the agenda, and he does have the authority to push people very, very hard to move towards doing difficult things and changing markets and changing the technology landscape. So he is an important figure, not only for the organization but for these end markets. And I think his viability as the CEO is important. And so these pay packages, I think, are ultimately pretty critical to keep him engaged and keep the organization focused on the things that shareholders want and having his buy-in to that.
Do you think that the board of Tesla is independent enough?
That's hard to say. In all honesty, the board has been very much bought into Elon as a leader, and how they keep that buy-in for him on a personal basis is a little unclear to me. These reports, in various papers around what happens in his personal life and how those relationships get managed. It's hard to double check the truth on those things, and they could be hearsay, they could be one-offs. And there's also just a lot of noise around Elon himself, just as a personality. And so that independence, I think, has been a very gentle line that everyone's watching here. But I think keeping his attention and buy into the organization is something that's critical,
Colin,
and how they do that is a little unsure.
What's the difference between buy-in and blackmail? Where's the line between? You know what I mean? You're competing. He's got all these different business entities. Oh, we have to give him this enormous pay package so he doesn't take his attention to something else, or take some of the technology from Tesla to something else. I mean, I don't know. Does that make?
Blackmail is a pretty aggressive term here, right? Leverage and negotiations and relationship management are something. My clear sense is that this organization is his baby and is his core focus, and is critical to all the things that he does. And so for him to wander off from an attention perspective seems unrealistic to me. I think the pay package and the alignment of interest remains I think critical. But I think if Elon stepped away from Tesla, it would be as damaging to him as it would be to the organization.
Colin, I want to get you out of here on this. Right now, you rate the stock a perform. Colin, what would you need to see to get more bullish on Tesla?
We really need to see margins bottom out here. We need to see them, slow down any sort of price declines so that the margins start moving higher. And what we've seen in other markets, whether it's solar, LEDs, even in batteries, is that going through the rationalization and the disruption of those markets can be really challenging from a price perspective and a margin perspective. And I think, as we see the competitive landscape evolve, what I want to see, with Tesla is really some real stable gross margins so it can see growth from there. The second thing that we really want to see is an evolution of the FSD technology and real adoption. We're still going through a pretty fluid environment around the regulatory backdrop. And as we get clarity on that, I think we'll have a better sense of how well this technology performs and their ability to monetize it. What we heard from them last quarter is that they went through a full re-architecture of the software, which is substantial, and that will take time to settle in, and what the benefits of that will be, will become clear over the next several quarters or a couple of years. But we want to see all that technology get implemented and really a more stable subscription base for the company to really drive some net recurring.
Colin, it's great to catch up with you as always on Tesla. Thank you. Appreciate it.
Thank you.
Let's get to some earnings now from Palantir. Those shares up some 12% after the company reported fourth quarter earnings. And what's interesting here is the company's first quarter forecast looks to be short of estimates, but that's not dinging the shares. Fourth quarter earnings per share of 8 cents, 7.6 cents is what analysts had been anticipating. This was also capping off the first profitable full year for the company. Also, fourth quarter revenue at about $608.4 million. That is above the $603 million that analysts were anticipating. And then finally, if we look at the first quarter revenue forecast, Palantir says at most its sales will be $616 million. That's at least $1 million short of what analysts had been anticipating. But for the full year, revenue will be $2.65 to $2.67 billion, and that's right bang on the midpoint. So maybe investors reassured by the idea that if they're not going to make those sales in the first quarter, they seem to be making them up somewhere along the way for the year.
Yeah, what's impressive too about this, heading into this print, the stock was basically flat so far this year, but it was already up more than 100% in the past 12 months, and you're tacking on another about 12% here in the after hours. There's going to be a lot of discussion on the call for sure about its AIP product, that's the company's artificial intelligence platform. So I'm sure investors, analysts are going to want more color and commentary about customer interests and metrics, where the demand is coming from for this new tool. Conference call starts at 5 p.m. Eastern, so you can expect headlines out of that.
Yeah, most definitely, and much more maybe, or at least some more hints on what's going on the AI front there. When I was talking about forecasts, I should also mention, by the way, the operating income forecast as well, which is above for the full year what analysts had been anticipating. So that's something to note as well when you look at the stock reaction that we are seeing here, which, to your point, is quite impressive considering how much we've already seen the stock go up. The company still very reliant on government contracts, which is something to keep in mind when you look at what Palantir does. So their shares up 13.5% right now.
Big move.
Yes. Coming up, Disney set to report its earnings after the bell on Wednesday. We'll tell you what to expect from the parks and streaming giant on the other side.
Stocks closing in the red, but it isn't all bad news. Nvidia among the stocks hitting record highs. Jared Blickery is here with the breakdown. Jared.
Nvidia record high. I don't believe it. I'm going to have to check this out. But, you take a look at the stock action for today. Small caps really took a beating, a little bit of a one, down 1.3%, but the Dow down 0.7%, NASDAQ only down 0.2%, not a huge day of losses. Now, let's take a look at the, well, there it is, Nvidia, record daily highs here, along with Eli Lilly, Costco, Booking, Caterpillar, Uber, Intuitive Surgical, Marathon Petroleum, O'Reilly Automotive. I've been showing a lot of these names day after day at various times throughout the year, but the list is a little bit smaller today. We got some ground to make up, and we don't have any indices in the record category today either. Now, I wanted to take a look at the mega caps. This is the top 10 U.S. stocks by market cap. I want to show you something that happened today. Tesla is now number 10 behind Broadcom, 576 versus 581 for Broadcom. Fell behind Eli Lilly in the 600s last week, so we'll have to see how this continues. Not going to read too much into that, but is worth a look there. Now, here's the sector action. Let me put the percentages back here. Healthcare finished up 0.3%, followed by tech. Want to show you a longer-term chart of healthcare. Guess what? It is on the cusp. It didn't break out today to a record, but it is on the verge of breaking to a record high. Based on the length of this consolidation here, if it does break out, I would expect a lot of continuation for months, if not a year or so. Financials recently broke out from a long-term resistance level. That was late last year. They've been continuing. Tech, for that matter, they were the first to break out late last year. And so we've been seeing a number of these sectors just kind of run up and break to those new highs. Now, when I take a look at the leaderboard, we don't have a lot of green here. In fact, we're looking at chip stocks and Chinese stocks. Those are basically the two winning categories of the day. Cannabis and disruption, that's ARC. Those are the two worst. And let's just take a look at the semiconductor space. You're going to see more green here than any other heat map I've seen today. And then for the flip side, let us take, or actually not for the flip side, but let's take another look at somewhat of a green screen. That is in China here. So Alibaba up 3%, JD up nearly 3%, but that is an ongoing saga. China trading on its own fundamentals, guys.
Jared, thank you so much. Really appreciate it. Looking ahead, Disney is set to report earnings on Wednesday after the close. All eyes will be on streaming subscriber data as industry watchers compare results to Netflix and other rivals. The House of Mouse predicting it will turn a profit in its direct-to-consumer offering by year-end. Our next guest believes that will not be an easy task. Let's bring in Doug Kreutz, TD Cowen, Managing Director of TMT Media and Entertainment. Doug, good to see you. So before we look ahead, let's just spend a moment looking backward at this quarter that they're about to report. And I do want to zoom in on streaming, which obviously has been challenged. What's going to be key to watch there, and how painful do you think it's going to be?
Yeah, they've already signaled to the street that subs should be down in the quarter based on price hikes they had toward the end of the year and probably what wasn't a super great content slate in the quarter. They've also said that in the early part of the year, kind of sequential loss improvement is probably going to be moderate. So I think they've sort of set the stage pretty well for what people should expect. I don't think there's any reason to think it'll be dramatically different than that. The question really comes as you go through the year, right? And they're driving towards that profitability target in the September quarter. When we look at their content slate for the next 9 months, it's a little bare. They've got content. They've got 2 live-action Star Wars shows, 2 live-action Marvel shows, but none of them are featuring characters that I would say are big draws. Their film slate last year performed not terribly well, so I don't know that any of those films are going to be big draws to the service. And their film slate for the first half of the year is a little soft as well until you get to Inside Out in June, Inside Out 2. So, they may have some continuing pressure on subs as we go through the year, and I think it'll be interesting to say kind of what their forward commentary for the March quarter is as far as their expectations.
And Doug, it's interesting, tomorrow too, I believe this is the first earnings call with new CFO Hugh Johnston. So I'm just curious, Doug, to get your take. One, what do you make of that hire? And two, Doug, what do you think his real priorities are here? Is it just going to be, it's got to be focused on cost savings and streaming profitability?
Yeah, he's got a spectacular resume. right? You certainly can't quibble with the hire from that perspective. People I've talked to who knew him at Pepsi had nothing but good things to say about him. That he's very much sort of, he's a good communicator with the street, and Disney needs that right now. I think not that they've been bad, but they have a complicated story, and they need someone who can tell it well. It'll be interesting to see if they get more specific with their forward guidance. Historically, they've not been a company that gives you a lot of guidance. They might give you a tidbit here or there, maybe a data point, but they don't sort of like guide to an EBITDA number or a revenue number or anything like that normally. Maybe they'll get a little bit more clear on what they expect, and that might help the stock in the near term. Of course, then they have to deliver, which is the tricky part.
And Doug, does Disney? I mean, Disney are already, as you said, the challenges are pretty well known. There's sort of a lot of moving parts in media more broadly right now in terms of consolidation, things moving around. Does Disney risk being left behind, or is the whole industry kind of in so much turmoil right now that they're all in the same boat?
Yeah, I guess the question would be left behind by who, right?
Right.
I don't think they're going to be left behind by Warner or Paramount. Obviously Netflix is doing pretty well, but Disney's still got fantastic content, and that's not going to change. Their content's always going to be valuable, right? The model of monetizing that content at an industry level is a little broken right now. It won't be broken forever, and Disney's content is strong enough that they'll survive to sort of, whenever we get out of this bad period, which could be a while, right? But no, I wouldn't worry too much about them getting left behind. Again, their content's just too good.
And Doug, when we talk about Disney, there's another big personality, strong personality, Doug, we have to talk about. That's Mr. Nelson Peltz. Disney's shareholder meeting, Doug, is scheduled for April. Investors will get a say on who's guiding this company going forward. Peltz has made it clear he wants seats at Disney. How do you think, Doug, that drama plays out, and what does it mean for the company?
Yeah, I have a hard time seeing him getting enough votes to actually get a board seat. He doesn't have that high a percentage of the share of the stock to begin with. I think it's like 2%. So he'd have to convince a lot of investors that his presence on the board is going to be good for them. And most of the investors I've talked to view this as a distraction. If you own the stock, you own it because you believe in Bob Iger. Bob Iger's saying he doesn't want Nelson Peltz on the board. So I suspect that the meeting will come and go and nothing will happen, and we'll be back to worrying about Disney's fundamentals as opposed to all this noise around activists.
All right, Doug, speaking of Disney's fundamentals, I want to get you out of here on this. You've got a market perform, I think, Doug, on the stock, so equivalent of a hold. What would you need to see, Doug, before telling your clients Disney's a buy?
I think there's a couple things. One is they need to figure out what they're doing with ESPN, right? Sports rights costs keep going up. They're planning to launch a direct-to-consumer full version of ESPN last year, and I think the success or failure of that is going to be critical for the company. Second thing is they got to get their content mojo back. I talked about all the great content they have, but for the last couple of years, they've been in a bit of a dry spell, and they need to kind of get back to making great content. And then the third thing is we need to find out who's going to succeed Bob Iger, because that's still a big open question that they've been trying to give an answer for 10 years, and we still have an answer.
Doug, it was great having you on the show. Thanks so much for taking the time to join us.
Thank you.
And still to come on Yahoo Finance, could your job be affected by generative AI? We talked to an economist on the other side of the break. Which sectors of the labor force could be most impacted by artificial intelligence? Stay tuned. More Yahoo Finance after this. A new report out from the Burning Glass Institute and SHRM suggests white-collar jobs in fields like finance and tech will be impacted the most by generative AI. Joining us now is Gad Lebanon, Burning Glass Institute chief economist. Gad, thank you so much for joining us.
My pleasure.
So the report suggests, Gad, that Gen AI, which is, for example, behind chatbots like ChatGPT, is going to have a big impact potentially on white-collar jobs. How come, Gad, and which job sectors particular?
Sure. Well, generative AI is all about large language models, so it's all about using language to both get knowledge and create content out of that, generate content out of it. So those functions or abilities are more likely to impact white-collar jobs that deal with language and less more physical abilities that most, let's say, blue-collar workers have. It turns out that human bodies are a very sophisticated machine used after millions of years of evolution, and it's pretty hard to completely automate. But language is actually much easier.
Surprisingly, perhaps. It's interesting that this report coming out now, there's also a post from Paul Donovan, who's an economist over at UBS, where he talked about the concept of stranded assets that lose their value more quickly than anticipated. And he suggested a skill like coding, for example, or other STEM skills could end up being stranded assets. And it's kind of amazing because coding was like the job to have. So how should people sort of think about the impact that this is going to have on the workforce and the economy?
Well, coding is a good example. I think sophisticated coding is likely to remain a hot skill, but simple coding, I think it's a matter of time, and in some cases already exists, that you can code with simple English. Like you don't need to learn a specific programming language to do that. So people who work mostly in kind of simple coding, I think their skills are going to lose their value to some degree.
And Gad, when you talk about Gen AI potentially impacting these white-collar jobs, what do you mean by impact? Are you suggesting you mean people could lose their jobs, or no, people just use this tech to kind of help them do their jobs more effectively?
I think both, but the bottom line is that even if it doesn't replace everything that white-collar workers do, it impacts some of it. And so they will become more productive, and they can do much more in a given amount of time. And typically, the demand for their services is not going to grow as rapidly. So in many cases, there will be overstaffing in those types of jobs, and that will lead to a reduction in workforce. But I should say, the reduction in workforce doesn't necessarily mean massive layoffs. A company could decide to just stop hiring for that type of job, and then natural attrition would do a job over time and lead to a reduction in workforce even without layoffs.
One of the other things that stood out to me in the report is that you say there will be potentially more demand for more mature workers or experienced workers. Can you explain that a little bit?
Yeah, some of the things that generative AI cannot replace is, for example, relationships and trust and those things that you build over your career over time. And so I think when that is important, generative AI is less likely to impact.
And Gad, what should be, listen, the people who are running some of the companies, they're involved in the sectors you're talking about that could be impacted. I mean, surely they're aware of this potential as well. What should they be doing to kind of prepare for that impact, in your opinion?
Well, I think the impact for them is mostly going to be positive. They are going to be able to do more with less and less labor cost, and as a result, profits are going to go up. I think things that they should be preparing for is, those jobs that may go away. What can you do to keep those workers in the company? How can you reskill them for other positions in the company? Because you may, some of them are very good and you don't want to lose them. So that's one example.
I noticed how journalists were mentioned in the report as well, but we don't have time to get into that one. Fortunately or unfortunately, I don't know. Gad, thank you so much. Gad Lebanon. We'll definitely keep an eye out for some further research from you guys. Appreciate it.
Thank you.
Coming up, we're going around the horn and checking in on some of today's top trending stories. Ali Kanal and Pras Subramanian are out on the newsroom floor with what to expect. Hey, guys.
Hey, Julie. Well, we're going to be discussing the latest note on Apple's Vision Pro, which one analyst thinks could ignite the company's earnings moving forward.
Plus, Rivian announcing it'll reveal its next EV in March, the R2, but is it enough to drive Rivian sales higher?
And soccer's biggest stage is coming to New York. Well, really, it's headed across the river to New Jersey for the 2026 World Cup. But we've got the details on all of that when Yahoo Finance returns.
Welcome to Yahoo Finance's group chat. I'm Josh Schaefer here with Pras Subramanian and Alexandra Canal. And today I want to talk about the Apple Vision Pro. When it was first announced, we sort of got mixed views on what to expect, right? We've been wondering what to expect from this product for a while now, and it was interesting to see some Wall Street banks coming out and starting to really give firm expectations for what they do expect for this product. Bank of America coming out and saying that they expect Apple's Vision Pro to contribute 68 to 89 cents per share to EPS, earnings per share, over the next 5 years. So kind of putting an actual number in estimates for what they expect this to bring to Apple. We know, of course, with all of Apple's other products and how product sales work,
you basically do attribute, okay, we expect you to sell X amount of units at so-and-so price, that's going to contribute this amount to earnings. And I just felt like for me, the Vision Pro, we weren't really there yet, right? In terms of what actually is going to happen and how meaningful it's going to be. But it seems like B of A at least coming out and saying this is long-term going to be a product to watch seriously in terms of Apple's growth.
Yeah, I was a little surprised at that, pegging that with 90 cent to EPS growth to EPS.
68 to about 89,
Sorry,
I believe it was.
for full year EPS. I mean, that's a significant amount for a product that I thought was actually pretty niche in terms of applicability, what its use cases for. They do mention bullishness. They're bullish on the fact there's 600 apps that are going to be out for that. So there's a bunch of different ways that product can be used. But my point is that I think this is based on, that growth is based on the product being cheaper. And I think if anyone can do it, Apple can do it. Tim Cook did it with the iPhone, did it with the iPad, brought down those really expensive initial prices down to like more palatable, what people could, most people could afford, I think.
Yeah, I think you said it, Praz. If any company is going to successfully do this, it is Apple. They have the technology, they have the data, they just have the means to really create this kind of fanfare, I think, over something like this. And you mentioned the apps, which I thought was super interesting. 25 apps that are already going to be built in, and then 600 that are specifically designed for the Vision Pro. Now, there are some notable names that are going to be off this list. Netflix, YouTube, Spotify, they've said they are not going to be making apps specifically for this, but perhaps they will down the line. We know Disney CEO Bob Iger is on board. He was on stage with Tim Cook with the Vision Pro headset.
Disney's
Remember
not
that?
going to do it?
Disney's going to do it.
Right.
But some of the competitors might not. But if this takes off and contributes to EPS, we know Apple has really been doubling down on the services side of the business. We've seen a lot of momentum there with the wearable devices, even with Apple TV Plus. There's a world there where I could just put on my Vision Pro, watch TV on a plane, a train. I mean, there's a lot of possibilities.
That was
here.
what I was going to say too. Is the other thing, right? To note from the research from B of A and sort of where they're coming from here. They're bullish on the services industry for Apple as a whole, and they like that part of the business. So then you think about how the Vision Pro fits into that, and it's essentially just an expansion of the services business, right? If you are making money off someone from Apple services and then you give them another product, it's not necessarily a reach to assume that the services will sort of grow as that hardware grows.
Yeah, service is a big deal for Apple, of course. And then, I saw the NBA. There's an NBA app for that. I don't know if you guys see it online. It looks really cool. You can basically put that thing on anywhere.
Sports is
watch
it's
a
a
game.
huge game changer.
We're all wearing one at some point and doing the
I hope
segment
so.
in the Vision Pro verse.
Apple, can you please send us some Vision Pros? Thank you.
Well, looking ahead to the future, right? So I've been looking at Rivian, the EV maker, confirming on Twitter it will reveal its next generation EV in March, the R2. This is going to be the Rivian's cheapest and most efficient model yet, but the crucial part is Rivian wants to produce it at scale. They have to sort of justify their existence as a company. We're talking about like a Model Y type of vehicle in that $45,000, $50,000 price range. Should be a high volume seller when it comes out in 2026, which again is down the line, and that's because they got to build a new factory for it. So I think that's sort of the bullish play here is can they actually get this thing done and then sort of emulate Tesla in terms of getting that volume car out there and making a lot of money.
I get Rivian wanting to do this, obviously, from a business standpoint, and for them to, as you said, continue to grow and be successful, and it makes sense for Rivian. I just wonder, Pras, based on the conversations we've had, the EV poll that you ran on our website, and we've discussed in this segment before, is there demand at that, what did you say, $45,000 to $55,000 range-ish? I'm wondering how big the demand is for EVs there. Like, how many people want an EV there? How many people are familiar with the brand Tesla? That makes them willing to buy it. Are you going to want to buy from a pure play like Rivian that you don't know? I just think there's a lot of questions there when it comes to demand.
I think Ali had a really good point earlier.
I was going to say, Praz and I were talking in the commercial break, and I was going to say, I actually think the timeline is in Rivian's favor, right?
Because it's later?
It's later.
Sure.
So you have the infrastructure coming on later, perhaps EV adoption picks up as, the mileage improves, the pricing improves. So I actually think that there could be more demand down the line, because that's always been the issue, right? Is that I think EVs are going to be the future. I think at a certain point, we're not going to have gas cars. it's just a question of when and how quickly we get there. But I think time is on your side if you're an EV.
Right. By 2026, there'll be like 4 chargers in a 100-mile radius for me to plug in at, right?
Yeah.
Sorry.
I'm quoting TV's Alec Canal, my next R2 story, right? That's the right trade.
Heck yeah, just put me on the EV beat, you know? But could never take over a spot. But I could be on the soccer beat potentially, because soccer's biggest stage is coming to New York. The MetLife Stadium in New Jersey will be setting the setting for the 2026 World Cup final, and it doesn't get any bigger than that, especially when we think about soccer fans. And look, when I first heard this, I'm a New York City resident, but I commute to Jersey often. I was like, how is this going to impact my commute? The New Jersey Transit. There's always some issues there. However, the economic impact really stuck out to me. This is from a joint press release from the mayor of New York City, along with the governor of New Jersey. And they said that the World Cup matches played at MetLife, including the final, are projected to generate over $2 billion in economic impact for the New York, New Jersey region, and will support over 14,000 jobs. And if you think about soccer, the interest there's going to be a lot of international travel, I think, a lot of tourism. Economic impact is pretty intense, I think.
So I will take the early bet that in the Fed Beige Book in August of 2026, when we're reading about this, right? But in all seriousness, when we think about kind of the Taylor Swift economy and what we talked about this summer with consumer spending, we realized that a lot of those numbers were real, right? Having the Taylor Swift tour combined with the Beyonce tour, these sort of post-COVID come back to concert moments really did stimulate the economy. And you wonder what this is going to do for broad U.S. economic growth in that summer month, in that third quarter, because it's going to be huge. You do not get to go to the World Cup outside of maybe once in a lifetime. And I think the spending, you probably can't really overestimate how big that spending is going to be.
Maybe it's the Kylian Mbappe effect, right? The French star. So, it's funny you mentioned New York, New Jersey. That's what they're calling the F word. It's like,
yeah, oh yeah.
I don't know if these Europeans know that the game is in actually the Meadowlands of New Jersey. I don't know if you've been to MetLife before, but it is actually a big, grand stadium. It could be a great final, but that effect on the cities is massive. It was LA and I think Dallas who were down for the final. They lost out. So those are big losses for them, right? If you think about it. I mean, New York's New York, right?
Yeah.
As someone that grew up next to Foxborough, Massachusetts, which is 30 miles south of Boston, the list that they put that the games will be in Boston, I also got a kick out of.
And we were trying to debate what stories to do today, and I had said maybe the Grammys, Taylor Swift. You're like, I don't want to talk about Taylor Swift. You wove in Taylor Swift into
I've always
the
want to talk about Taylor Swift. I say I don't want to talk about Taylor Swift, so then I can still talk about Taylor Swift.
Super Bowl is this Sunday.
We still got to bring up Travis later.
I know, okay.
Super Bowl's on Sunday. We're going to have to find another Taylor Swift angle, but coming up, we're going to get you set with what to watch on your Tuesday. Sorry about that. We're about halfway through earnings season, though, and let's take a look at some of the winners and losers from the latest quarter. Really, you're only missing Nvidia in terms of massive tech companies to report this week. And really, guys, I think the story here is understanding how big this is going to be for the overall market.
It's another year of overcoming a lot of challenges. As we think about 2024, it really is a year of execution for us. We've got the roadmap. We talked about 200 to 300,000 EVs being produced this year. We've got confidence of getting to variable profit positive in the second half of the year on our journey getting to mid-single-digit margins by 2025.
People are really focused on this move to generative AI, and that seems to be a very big focus longer term for the street, where Google has had basically a monopoly on search. With generative AI, you've got different players at least trying to dethrone them in some way.
Generative AI is 1 year old. We're 1 year into this new AI cycle. Microsoft, they disclosed their AI business actually doubled sequentially. It's now a $4.4 billion run rate business in year one.
We had a strong quarter in Q1, and it was really driven by our most loyal customers remaining engaged across the globe. And so as we think about going forward, as we look to some maybe more near-term and transitory headwinds, what we're really focused on is continuing to drive customers into our rewards program.
The fact that there's no guide here isn't really a suspension so far as I can tell. And I would attach that to not wanting to get ahead of the FAA. The FAA has asked for a freeze on the 737, arguably the most important product they do. And I think they're just being smart and not trying to get ahead of the regulator.
We're really happy and very proud about the results we delivered this morning. Being able to grow the company by 36% is historic in our context, and in an industrial context in the pharmaceutical industry, growing 36% in an industry growing to the tune of 4% is also very, very special.
When people buy a new phone, they're buying a more expensive phone. And so we're seeing this tremendous mix shift towards more expensive devices, towards more expensive chips. And that shows up in our revenue growth.
The strong guidance for Q1 got it essentially above the street for revenues for Q1. And then the dividend, obviously investors are going to like that, showing continued expense discipline on their part. And so I think investors are really more focused probably on the guidance and the dividend for Meta.
At $13.2 billion, which is what they did in the quarter, you have a trajectory that's, leading the company towards kind of a 10% bogey in 2025 now, which is not something that investors were expecting.
The number is a miss overall, but I think it's not a major disaster because it's all about the future here going forward, how they get the generative AI into their whole mix and all that. So there are a lot of other levers that they can pull, but at this point, it is definitely a disappointment that two areas that we were concerned about did disappoint.
Time now for What to Watch Tuesday, February 6th. Starting out on the earnings front, Eli Lilly, Toyota, BP, Ford, and Snap all reporting results tomorrow. Eli Lilly climbing more than 5% today ahead of its earnings release, and shares of Snap move lower after the company announces plans to lay off 10% of its global workforce.
Shifting gears, get it, to some auto earnings. Ford's quarterly results are on deck after reporting a strong start to the year with sales surging in January. Toyota also reporting tomorrow, the company trying to build supply back up after being hit by inventory issues and chip shortages.
And turning to the Fed, a slew of Federal Reserve officials set to speak on Tuesday. Loretta Mester, Neil Kashkari, Susan Collins, and Patrick Harker scheduled to talk throughout the day. This coming after Fed Chair Jerome Powell's news conference on Wednesday and his appearance on 60 Minutes, tempering expectations for a rate cut in March. And what are you watching tomorrow, Julie?
So I want to dig into Eli Lilly a little bit because I was just checking the market cap is still well above that of Tesla. Remember, we noticed that milestone when it got bigger. It's something like $670 billion in terms of its market cap. Rose today after Novo Holdings, the parent of Novo Nordisk, agreed to acquire Catalent, which sort of addressed some of its GLP-1 supply chain issues. There have been some similar concerns with Lilly, so we'll see what they say about that tomorrow. Of course, Lilly makes Zepbound, which is its new weight loss shot, as well as Mounjaro, and anything that has been touched by GLP-1s, as we know over the past year, has gone crazy. So Eli Lilly falls into that category. So we'll be looking to see what they have to say about those two drugs in particular, and see if they can continue this record run that the shares have been on.
We shall see. Spotify on my radar. They are reporting earnings results tomorrow. Of course, in the news, just signed this new deal with Joe Rogan, reportedly worth about $250 million. Nice work. As for earnings, key metrics to watch besides the bottom and the top, MAUs, premium subs, gross margins will be in focus. Evercore's Mark Mahaney, who we know well, Mark, very well-respected financial analyst. He likes his name, Julie, and recently raised his price target to $245.
Wow. Well, we'll see how they end up doing. All right, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.